a discussion forward with a very special guest joining us today, Chetan Ahya from the sidelines of the Morgan Stanley conference, which is happening in Mumbai. Chetan, of course, is the chief Asia economist. Chetan, morning and thanks very much for joining us today. You know, the Indian market and market environment economy seems to be very happy right now. It appears that the global headwinds, which we also had to face, are dimming or at least going away. How are you looking at the environment today on the economic side versus say 8-10 months back? How much easing has already happened on the real issues? Then we come to the rates and inflation trajectory.
Yeah, so look, I think from an external perspective, we had a big challenge in terms of commodity prices going up. And as you know, India is a big oil importer, so that was affecting India in terms of inflation as well as current account deficit. So that's now faded. But we still have the challenge that, DM growth is slowing. We expect it to slow further. And that will have an impact on India's external demand and exports. So the external environment is still not that supportive. But our view on India is that it is actually at a position where it has tailwinds from structural as well as cyclical factors, and it will help India outperform in still not so great an external environment.
And Chetan, just seconding that view, I mean, activity in India, and we're looking at all macro indicators here, is actually holding up pretty well, right? With the GDP now also above expectations. RBI clearly made their point that they're pretty much in pause mode. But what could be the economic impact in India? What I wanted to understand is, what is your sense on the FY24 GDP number, considering that now we're working with a higher base?
So we expect, I'm looking at the numbers on a calendar year basis, and for 23 and 24, we expect average GDP growth for India to be closer to 6.5%. Yes, it's a higher base, but we do see that the momentum in the activities has picked up quite nicely. So two key numbers I will cite here. If you look at services PMI, it's close to 13-year high. If you look at manufacturing PMI, it's close to about 11-year high. So the momentum in the activity has really strengthened, and it's all reflected out of the strength in domestic demand. So we are seeing consumption now broadening out. Initially, it was largely services after we reopened last year in April 2022. And it's now transitioning towards more balanced recovery in consumption with goods and services coming together. And the investment line is also picking up. It was somewhat unbalanced in form of the fact that public sector capex was picking up, but the private sector was holding back. And now we are seeing that the private sector capex is also picking up. So there's a broadening out of domestic demand recovery that's reflected in various sectoral data points.
What about inflation, though? Because, that's always been a niggling worry when it comes to India, Chetan. And would you say that it's much under control? Because those 3-digit figure days for oil seem to be way behind us. It seems pretty much under control. Besides El Nino, and, we will soon know about that, the monsoon forecast that is, and oil, could there be other downside risks to India at this current juncture?
In terms of inflation, I think, the framework that we've had is that bulk of inflationary pressures that we have seen in Asia and India have been driven by cost push factors, i.e. commodity prices. And of course, that rise in commodity prices was accompanied by currency depreciation. So it was really more imported commodity prices which were transmitting into India's inflation. And so if you look at core goods, so within core inflation, if you look at core goods, it's very tightly linked to what happens to commodity prices and currency. And to the extent to which now commodity prices have declined, we think that the overall inflation outlook in India is looking now comfortable. And we're expecting that, a bulk of the region will have that, where inflation will be within central bank's comfort zone. and that will sort of be not an issue going forward. In terms of the risk of what causes inflation to come back up, and you mentioned one about the weather conditions and its impact on the agricultural output. The other one is, again, still oil. The geopolitical risks have not gone away. And if that arises back again, that would be the second risk to watch. I think demand-led inflation could be a risk, but it's still some time away. At this point of time, we don't think that the demand push inflationary pressures will be strong enough to worry about in the next 12 months.
Very interesting that you mentioned that, Chetan. And I definitely want to get your thoughts in on what your prediction on oil is, because I don't think any economist can be only an economy watcher and not wear a commodity watcher's hat right now. Where do you think oil is headed next?
So look, I am not a commodities analyst, but I will cite the views of our strategy team. And they are sort of thinking oil to be behaving well and remain within $75 to $80, the Brent crude number. And that's because there are challenges on the demand side as well as on the supply side. On the demand side, we still have global goods economy going through some kind of challenges. So if you look at external demand and exports, which would be one indicator of what's happening to global goods demand, that's still relatively weak. And oil, or rather the industrial sector, accounts for about 20% of global oil consumption. And on the supply side, they are citing the fact that the producers, some of the ones like Russia and smaller producers, smaller countries, they have managed to increase their production, and therefore the supply side is also sort of supportive to for oil prices to remain between $75 to $80.
Chetan, morning. Wanted to also get in your take on what central banks across Asia in particular have been doing, given that they have been in pause mode. What's your outlook given your inflation projections? Do you think that this is durable, and what's the expectation from the Reserve Bank?
So our view on that is that for 80% of the region, inflation will come down within central bank's comfort zone by third quarter of this year. And that will mean that central banks will begin to take up rate cuts from the fourth quarter of this year, i.e., quarter ending December 2023. We expect Bank Indonesia to be the first central bank to go ahead in October this year with a 25 basis points of rate cut. And for RBI, we think they will be able to take up rate cuts in first quarter of next year.
Chetan, though clarification on that pause or a pivot kind of have come from our own governor as well as US Fed, and you did speak about the year end. What could be the trajectory of rate cuts going into the next year? How many cuts are we talking about from the US Fed as well as from our own governor next year?
From the US, we're expecting 4 25 basis point rate cuts. So expecting about 100 basis points of rate cuts in 2024. For the RBI, we're expecting just about 2. And that's because growth will be still relatively strong, and the central bank would want to have opportunistic disinflation, taking inflation closer to that 4% target that they have. So it would be, in our view, not fair to expect more than 50 basis points of rate cuts for the Reserve Bank of India.
Chetan, one end of the overall economy, which is manufacturing, appears to be firing on many cylinders. Global manufacturing PMI appears to be in a contracting mode, whereas India PMI, manufacturing PMI, is actually expanding. How do you see the velocity of this continuing for the next few years, the way public sector has been leading the manufacturing push so far, but early signs of private sector also joining in, coming in now?
Well, I think the driver to India's PMI being so strong is that strength in domestic demand that I was mentioning earlier. And we're expecting that to continue. So we have support for the manufacturing sector from demand perspective, from pickup in goods consumption. And at the same time, we are seeing, that there has been pickup in the investment activity. So both consumption and investment goods demand is helping manufacturing sector to show that acceleration, and that is likely to continue in India going forward as well. So yeah, we would be confident that manufacturing sector PMIs will hold up in India and will continue to outperform rest of the world, because for US and Europe, we are expecting that this inflation rise that we have seen will mean that they will pay the price of that high inflation in form of higher interest rates, constraining their domestic demand. And in fact, US and Europe GDP growth is expected to slow down in the next 2 quarters, which will mean that India's manufacturing sector will continue to outperform US and Europe.
Chetan, we are also having this conversation at a time when this government is finishing 9 years in office and is looking ahead. One of the initiatives they have taken on the PLI side to boost manufacturing has been welcomed by the private sector and corporates. But what about PLI-linked manufacturing, which is actually happening looking externally? If the recipient market itself slows down, what will be the, how will this entire manufacturing sustain itself?
Well, as far as the manufacturing sector linked to global marketplace is concerned, it has to be more thought through in form of increase in market share. So as we know that there are certain sectors in which companies are thinking of putting up establishments in India, and that is more like India beginning to have greater presence and increasing its market share in global goods exports. Currently, India's market share is about 1.8%, and there is scope for this to go up meaningfully over the next 5-6 years. And in fact, our India economist is expecting that this will go up and almost double by 2030. So I think that's where there will be an opportunity for the manufacturing sector linked to the external demand.
Chetan, amidst this entire de-dollarization debate, which is currently on globally, right? What I wanted to understand is, what do you foresee for the rupee? And do you think the worst of the weakness could be behind us?
So look, I think the rupee is now, we think, more going to reflect what happens to the dollar generally against all the currencies. It isn't a country-specific challenge that will cause additional depreciation in the rupee. But if, look, the dollar rises, and that is the house view that we have, that the dollar will be strong in the near term, there will be that attendant impact on the rupee, and there will be some depreciation pressures. But fundamentally, on the country-specific aspects, we are not worried about the rupee outlook. I think to the extent to which dollar could strengthen, whenever there is a concern on US recession, there is that flow of money that goes towards US Treasury, and it strengthens the dollar. So that's the view of our global macro strategy team, that they expect that strength in the dollar with the concerns on risks of recession getting priced in the market. And unfortunately, during that period, there will be some depreciation pressures on the rupee, but it's not really a country-specific problem that will be causing that depreciation.
And what is your view at large, given that global financial systems across US and Europe seem to be slipping up, although well handled, and so was the debt ceiling? But what is the view on the US economy right now? Is a recession now inevitable? Are we talking about a soft landing, hard landing? What could be the contagion impact?
Yeah, so we are in the soft landing camp. We think US growth will slow. It will slow to 0.4% on a year-on-year basis by the fourth quarter of this year. But we think there are 2 key aspects of the US economy which are different in this cycle, and that's what helps us avoid a deeper recession. And number one on that front is that the corporate and the household balance sheets are in a very different shape. Typically, what happens is you get to stall speed rates of growth, and then either the corporate or the household balance sheet defaults, exacerbating the downturn in the economy. So we don't have that in this cycle because bulk of the leverage pickup that happened in the economy since the trough of COVID crisis has been driven by government leverage rather than private sector leverage. And that's unique. That usually doesn't happen in previous business cycles. And number two is that the corporate sector has not overhired. You just saw the job growth number that came out last Friday. It was about 300,000 jobs added. And that's because the economy has been operating with some kind of shortage in labor. And so, when you are seeing this slowdown, the first reaction from the corporate sector would be to fire workers. But they're not doing that because the starting point is not at a point where they're overhired. So I think these two aspects makes us feel comfortable that the US should be able to achieve soft landing.
And what's the outlook in terms of the consumption trends as well, given that you have the full reopening as well of the Chinese economy? How are you looking at a consumption recovery playing out with a lag effect? How does that stack up versus India?
Yeah, so actually, usually most of the countries in the region move in tandem. But in China's case, in this cycle, it is lagging the rest of the region. And we have been using the developments in India as a sort of benchmark to follow for China. One thing which China is similar to India and rest of Asia in this cycle is that they have not taken up aggressive fiscal transfers to the households like US and Europe. And so the economic recovery on the consumption side is more organic. And so what we saw in India's case is that initially you tended to see pickup in services sector spending and then goods join later. And in terms of the income segment, it's the middle to high income segment that goes first, and then the low income to middle income segment joins the recovery. And you are seeing that in case of two-wheeler sales in India versus car sales. Two-wheeler sales are now looking like they are picking up. And there was a challenge in the initial period as soon as the recovery began in April 2022 last year. So in China's case as well, we think something similar is happening. Right now, services sector PMI is looking strong, but the goods spending has not picked up as much, and so therefore the manufacturing sector is not yet strong. And the higher to middle income segment has first taken off. So if you heard the results of luxury companies, luxury goods segment companies, multinationals, they all felt that they had good uptick in China sales, but the mass market products has not yet still seen that full recovery. So we think China's consumption recovery is on track if you wear this lens of analyzing what happened in rest of Asia. And I think by the time another 6 to 9 months, you will have more broad-based recovery in China as well.
Chetan, what are your thoughts on flows into Asia, particularly India? Because after witnessing a very long spell of outflows, past few months, FIs seem to have come back to India. Even on the flows on the other side, FDI, we are seeing one MNC after the other coming to India, talking to us. Economic Times front page splashed that, want to set up some manufacturing or expand business, Tim Cook, Foxconn, to name a few. How do you see the situation in India next, say, 12 months on flows front, both from FDI and from FIs? Because you're talking about.
Yeah, so I would really borrow from our strategy team. So our regional strategist, Jonathan Garner, is quite constructive on EM and Asia relative to DMs. So on a relative basis, we are expecting EMs to get more attention in the next 12 months. And broadly speaking, the macro dynamics in Asia is very different from what you're seeing in the US and Europe. So number one factor that is putting Asia and India in a different position is that we've not had a big inflation problem. And so therefore, we've not had a big interest rate shock. So if you look at the weighted average policy rate increases in Asia, it's gone up by 100 basis points. Whereas in the US, it's gone up by 500 basis points. And in Europe, it's gone up already by about 375 basis points. So we've seen a very different interest rate environment, and the monetary policies in the region are supportive to get the domestic demand growth going. Number two is that, we have country-specific factors. So India's story we already discussed. We expect China's reopening-led demand, domestic demand, to pick up going forward. Similarly, there's another two countries, which is Indonesia and Japan, which have country-specific factors driving domestic demand. So that builds up to a very attractive growth opportunity, and we're expecting regions growth to be at 5.1% by the fourth quarter of this year, whereas the US will slow down to about 0.4. So there will be 460 basis point growth outperformance. And that's what we think will drive the attention of investors to the region. But within that, India is one of the best performing economies in terms of the growth differentials. So certainly India should also see that benefit of that attention that investors pay down to the region.
Chetan, so great having you on the show today, and thank you for taking time out and speaking with us. Have a good conference.
Thank you.
Okay, that's The View coming in.